Keeping the same structure, same examples. If some kind of Freaky Friday moment happened and I woke up in 2026 with no money, no investments, and had to start completely from scratch, but I still knew everything I know today, I'd have a massive advantage. When I made my first investment, I didn't have that luxury. I wasted hours researching random stocks, chasing whatever was hyped up, and trying to guess what would take off. It took years to realize that investing doesn't have to be complicated. It just has to be consistent. So if I had to start all over again in 2026, this is exactly how I'd start. Step by step to build wealth faster and with less stress. So picture this. It's the start of a new year and you finally managed to set aside $1,200. You could save it or you could invest it, but which one actually moves you forward? Let's look at the numbers. Inflation in the U.S. averaged around 2.7% in 2025 and is projected to hover around 3% in 2026. This means that the cost of everything from rent and groceries to your morning coffee is slowly climbing. If you spend $3,400 a month in 2026, a 3% inflation rate means that your expenses could rise to about $3,500 by next year. It's not that dramatic month to month, but it does add up. Now say that you're old school, and you decide to stash away $1,200 in cash. The $4 coffee you buy in January might cost $4.12 by December, but the $1,200 in your piggy bank will still only be $1,200. So in reality, you're actually losing money. However, if you keep your money in the bank, you could put it into a high-yield savings account, which right now offers between 3, 4, or 5% of interest. This would turn your $1,200 into roughly $1,254 after a year. That's better, especially because it keeps you ahead of inflation, so you won't feel the impact of the higher coffee prices in December. But it's still not going to help if you want to build wealth. You see, when you save, the bank pays you interest because it uses your money to lend to others. However, when you invest, you become a part owner of a business that's trying to grow, and you earn returns when that business succeeds. So take Apple, for example. If you bought one share of Apple back in 2010 for about $10, the same share would be worth over $200 today, not even counting the dividends. That's a 20x increase that long-term investing can do that saving simply can't. When a company grows to a certain size and wants to expand, it lists on a stock exchange like the NASDAQ or NYSE, so anyone can invest. Teachers like myself, doctors, students, and regular people like you and me. So if I had $1,200, I would actually choose to invest it because unlike a savings account that might earn you 4 to 5% a year, the stock market has historically returned about 7 to 10% annually over the long term, even accounting for market ups and downs. So, saving keeps your money safe from inflation, but investing helps you take your finances to the next level. Now, investing works when you put your money into companies that actually perform well. If we go back to Apple, we all know how quickly it grew through the 2000s, and as the company succeeded, its investors did too. But not every company has that same story. Another smartphone brand from the same era was Palm. They tried to sell small companion phones that would pair with regular smartphones, a concept that sounded smart at the time. Even big names like Bono from YouTube believed in the idea and invested $460 million into the company. But Palm struggled to stand out against Apple and Samsung. By 2010, the company was sold to HP for just about $1.2 billion, which was a fraction of what early investors had hoped for. And within a few years, the brand completely just disappeared. When I first started investing, I spent hours studying new companies, watching endless videos, and following every business headline I could find. I thought I was being super smart, but I was really just making things harder and more risky than they needed to be. You see, if you put all of your money into one company and it fails, you basically lose everything. That's exactly what I realized when I discovered index funds and exchange-traded funds, or ETFs. An ETF is built by an investment company like Vanguard or Schwab, and it includes shares from many different companies. For example, SPYM, or formerly known as SPLG, is an ETF that tracks the S&P 500, which is made up of the 500 largest publicly traded companies in the United States, like Apple, Microsoft, and Amazon. When you invest in an ETF, two important things happen. First, you lower your risk because you're not relying on one single company to perform well. Second, you save time because you don't need to constantly research or monitor individual stocks. Some of the most popular ETFs include VOO, SPY, IVOO, and QQQ. If I were just starting out, it's usually best to just stick with an index that tracks something like the S&P 500 because it gives you exposure to a wide mix of stable, well-established companies that have historically delivered steady long-term growth. So, if I were to make my first investment today, I would definitely be investing in an ETF, probably SPYM or QQQM, because I like how it focuses on innovative tech companies in the NASDAQ 100. And honestly, if this all feels overwhelming, it's totally okay. You can join my next Beginners Investing Masterclass. I'm going to walk through everything with you step by step to help you make your first investment as a complete beginner. I'll leave the link down below if you want to join the class today or tomorrow. Now, once you know that you want to invest and you've decided what to invest in, the next question is when to start and how much to actually put in. You see, anyone can really invest, but there are two situations where I'd hold off before encouraging someone to actually jump into the stock market. The first is high-interest debt. Let's say that you pay for your wedding on a credit card and now owe $5,000 at an interest rate of 23%. Every month, you're paying back part of that $5,000, but you're also paying another $95 in interest, which is basically having a fee for having borrowed that money in the first place. Now, that fee doesn't go away until you fully pay off that debt, and the longer you carry it, the more it slows you down. So, if you have an extra $1,200 sitting around after your usual repayments, I'd add it to my debt repayment instead of investing it. To me, debt is like having a slow puncture in your car tire when you're trying to drive home from the holidays. You can keep stopping to pump it up, but it's going to keep leaking, drag you down, and you might never arrive in time for the festivities. The second thing is not having an emergency fund. When you invest, you typically want to leave your money untouched for at least 5 or 10 years, or even longer if you can. So, if your laptop suddenly dies and you need $800 to replace it, or you get into a car accident and you need to pay for physical therapy out of pocket, you don't want to pull that out from your investments. And that's exactly what an emergency fund is for. For my community, I usually say that they generally want to have at least 3 to 6 months worth of living expenses sitting in a high-yield savings account so your money keeps pace with inflation but remains easy to withdraw when you need it. When you sell investments, it can take a couple of days for the cash to clear, and more importantly, you lose the benefit of long-term growth each time you dip into it. So, before you start investing, make sure that you've done two things. First, paid off any high-interest debt, and second, built an emergency fund that covers at least 3 to 6 months of expenses. Once that's done, I believe that you're ready to get started. Now, you don't need $1,200 before you can make your first investment, or even say $500, maybe even $100. Many platforms let you start with as little as $1, but it's important to understand that the more that you put in, the more that you'll actually get out. If you invested $1 a month for 40 years and earned an average annual return of 10%, you'd end up with about $5,300.